All right, Ken, talk us through the markets. We'd seen the 3,500 resistance level. It touched that last week. We were starting to think the market was buoyant, a little bit encouraged. Not quite so at the moment.
I would say I actually didn't really fall for it. I think the activity we saw was driven mostly by, there was one foreign investor who came in who was buying up quite a bit of Barclays. And also, I mean, this basically got the local retail and local institutional investors quite excited, because Barclays went up by more than 15–20%. So what happened is they all came into the market, and also buoyed by the results were not that bad for the third quarter. But what happened, I think the gas has run out, and we should see, because the fundamentals had actually not changed. Yeah. They were still the same as they were a month ago.
I mean, one of the worrying things, obviously, and it's largely due to the international environment in general, foreigners have held back from this market. So to a large extent, this market in Kenya is being driven by local participants. They now account for about 70% of activity that's taking place there. What are they interested in? Because we're starting to see a stronger shilling, but that hasn't translated necessarily into more entry on the fixed income side of the market.
No, not really, actually. I think we expect, most of market participants expect the rates to still move higher, and also we still expect the equity market, especially going forward into 2012, which is an election year, the risks increase in this market, and globally there is a risk aversion. So we do expect the market may weaken somewhat before it begins to strengthen. Also on the fixed income side, what happens is when the interest rates are quite volatile at the moment. So most players would rather stay short, play the money market, 91-day T-bill, and keep it there until rates stabilize.
All right. We're now seeing additional action on the part of the central bank. This time they're going to be reviewing banks that are coming onto the discount window to borrow more than twice in a week. As a result, banks are said to be holding back in terms of their forex acquisitions. What does that mean?
Basically, what happened about I think 3 months ago was we were seeing banks coming to the discount window, and which was at a lower level than the interbank market, and taking advantage of the arbitrage, borrowing at the central bank window and lending on the open interbank market. So what central bank did is they came up with a formula that ensures the CBR window, which is the discount window, is never below the interbank rate. Basically, so what and monetary policy they're really trying to tighten monetary policy. They're coming into the market every day, almost every day actually, looking for money through repo. So all avenues for liquidity are being tightened. So that's basically what the central bank is trying to do.
All right, on the equity side, you did say that, you know, despite some very good results for the third quarter, it hasn't drawn investors back. Whose results impress you the most? Because later on we're speaking to the Deputy MD of Ati River, and I'm really surprised to see the 61% drop in net profits.
I think basically for that industry, it was more or less expected. What we're seeing is costs of production have shot, they're quite high. Also, as you mentioned, because of foreign debt, also there's unrealized losses on this end. So, and basically there's a lot of competition in the cement industry. So what we are seeing is cement companies are holding their prices. These prices, cement prices have actually not risen in the last, actually I think 5 to 6 months. So of course they are bound to take a hit. As long as the shilling remains weak, the cement industry is in for difficult times. And also the lending rates have shot up quite a bit. We expect there may be a lag effect, but we expect this to affect the real estate industry.
Explain that to me, because for the longest time we've been saying if there's one sector that remains resilient in the midst of a depressed market, it's the cement industry, largely because the demand for real estate has really grown significantly in Kenya. And that seemed to fly in the face of rising interest rates, inflation. People just want the opportunity to own a beautiful and a new home.
That is true, and I mean, we've seen a boom in this industry for over the last 5 years. But as I mentioned earlier, there's always a lag effect in the real estate industry between borrowing, breaking ground, and the finished property being sold off in the market. So we might not see the effect this year. It usually takes between 12 to 18 months to see the effect on the real estate industry. And I think maybe by about the end of 2012, we should start feeling the effects of a slowing down real estate industry. And also in terms of demand, yes, there is quite a bit of demand, especially middle class and lower income housing, because the higher end has really slowed down. But also the effects of inflation should also, the lower middle class and lower end will start to feel these effects, and these will affect this sector of this industry.
Okay, throwing forward, we're expecting Safaricom's Q3 results on the 9th of November. What do you expect there? Because the share price hasn't been particularly impressive.
I think what happens with Safaricom, it's a whole different ball game, mostly traded by foreign funds. In fact, most local investors, institutional investors, just sit out Safaricom. So the share price has basically been range bound between about 2 shillings and 80 cents and 3 shillings and 15 cents. We do expect them to make a profit, but let's wait and see because of the telecoms war that's been going on between the 4 companies, the price war. So this may affect their bottom line.
Okay, we've come to the end of our interview. Anything else that might impact on the trends of trading this week, Kenneth?
Of course, I think we'll still see subdued trading on the fixed income market as investors sit out to see where rates will go. The interbank rates have shot up above 24%. Deposit rates are a lot higher, they're about 20%. So most investors are sitting out, playing the money market. We'll just wait and see.